Let's talk about the investment advisor, financial advisor trap. You know, back in the day, I used to work for some of the biggest investment firms in the world. And you would think, well, you just hire one of those firms and you ought to be great. Everything ought to be okay because they got big because they were good, right? Not necessarily. I'm going to tell you some of the worst practices that I have ever seen came from some of the biggest investment firms out there. Now, another thing that people will do is they say, well, nowadays you hear people talking about being a fiduciary. Can't we just hire somebody that is a fiduciary? Not necessarily. That doesn't help either. You would think hiring somebody that's got to keep your best interest first would be the panacea. That would fix everything, right? Well, what is a fiduciary? That is a person that must act in your best interest. And you think, man, that sounds great. But did you know that you can engage in some practices that are pretty destructive and still call yourself a fiduciary? I'll give you one example. You can engage in stock picking or market timing and still call yourself a fiduciary. Now, these pie charts right here actually show you investment managers trying to outperform various areas of the market over the past 15 years. And what you notice in this research right here is that the vast majority of investment managers can't even keep up with the market in segments that they're investing in. In other words, they're trying to pick which stocks are going to do better than others, and they're underperforming what the market does on its own. And so, well, that's okay. We'll just hire the people that had good performance in the past. Well, the problem there is that the good performers from the past don't tend to repeat. It's a problem. It's a huge problem. So that doesn't help at all. Now, do they call it stock picking? And the answer is no, they don't call it stock picking, so you can't just look for that language. You have to read the ADV or the prospectuses and look for terms like fundamental analysis or technical analysis. And the idea behind these two terms right here is we're looking for companies that are maybe undervalued, stocks that are selling for less than what they're really worth. So we want to buy them because it's a buying opportunity. Or they might say that what we're doing is we're also looking for overvalued companies so that we can short them or get rid of them out of the portfolio. And the idea is that we're going to find what the fair value of a stock really is, keep you out of the bad ones, and put you in the good ones. Well, as you saw right there, performance hasn't been so great. The reality is they don't tend to be able to do what they say they can do. Now, the other thing I did is I asked AI a question. I said, can a financial advisor advertise as a fiduciary but take the hat off and actually not act in that capacity? Now, I knew the answer to the question already, but AI rightly answered that yes, the financial advisor can advertise as a fiduciary, but operate under a lower standard for certain activities. Now, what are those activities? Well, they can engage in sales of mutual funds, commission-based mutual funds, or annuities, or insurance products, and actually take the hat off in the sales process. Now, what happens? What's the problem here? Well, AI points out, it says that for duly registered advisors, that's what they're called, the standard of care changes depending on the product being sold. The problem for clients is that the transition is often not obvious. Now, the advisor may act as a fiduciary when giving financial planning services, but switch to the non-fiduciary role when recommending a specific commission-based product. Now, this is the problem for the investor. They're looking at this person or hearing the advertisement in their mind saying that I'm a fiduciary, and not recognize that the standard has changed in the sales process. So what do? I mean, literally, they can stock pick, they can market time, they can take the hat off. My recommendation, just hire somebody like us. We never engage in anything commission-based, and we always use evidence-based investing standards and academic standards when investing in our clients portfolios. Then it takes some of the trickery out of the whole process. This is a lot easier.